Let me guess. You've heard words like stocks, crypto, Bitcoin, and your brain immediately said, yeah, rich people stuff, not for me. But here's the problem. You understand TikTok trends faster than money. And that is exactly why money is confused about you. Two people earn the same salary. One invests, becomes rich. The other buys random stuff on sale, and somehow still ends up broke. Guess which one most people are? Alright, forget everything. Let's start with something simple. Imagine you open a pizza shop. Not a fancy one. Just you, your friend, and one oven that sounds like it might explode. And somehow, your pizza becomes famous. Like, people fighting outside your shop famous. Like, your ex comes back famous. A stock means owning a tiny piece of a company. Imagine buying one slice of pizza and suddenly calling yourself the owner of the entire pizza shop. If the company grows, your slice becomes more valuable. If it fails, your slice becomes emotionally expensive and slightly painful to accept. A shareholder is someone who owns shares in a company. You don't work there, attend meetings, or fix problems, but you still feel proud when profits increase. It's like being part of a team without showing up to practice, yet celebrating like a champion when things go well. A stock exchange is a marketplace where people buy and sell shares of companies. Instead of fruits and vegetables, people trade ownership in businesses. Platforms like the New York Stock Exchange connect buyers and sellers, so trading happens smoothly, quickly, and sometimes emotionally. An IPO happens when a private company decides to sell its shares to the public for the first time. It's like a business saying, "We need money and trust you enough to invest." Early investors celebrate, while new investors hope they didn't join too late or too early. A bull market is when prices are rising steadily and optimism is everywhere. People feel confident, start investing more, and even beginners suddenly act like experts. Social media becomes full of advice, predictions, and excitement, and everyone believes the upward trend will continue forever without interruption. A bear market is when prices are falling and fear spreads across investors. People panic, sell their assets, and suddenly become quiet about their investments. Conversations change from profits to regrets, and everyone starts acting cautious, waiting for stability before re-entering the market again. Market capitalization is the total value of a company calculated by multiplying share price with total shares. It helps classify companies as small, medium, or large. For example, big companies like Microsoft Corporation have huge market caps, showing their overall size and influence. Volatility describes how quickly and dramatically prices change. High volatility means big ups and downs, which can create both profit opportunities and stress. Investors often feel excited during rapid increases and nervous during sudden drops, making it a key factor in understanding risk in markets. The bid price is the highest price a buyer is willing to pay for a stock. It represents demand in the market. If many buyers compete, the bid price can rise. It's essentially the buyer's offer during negotiations, usually lower than what sellers are asking. The bid price is the highest price a buyer is willing to pay for a stock. It represents demand in the market. If many buyers compete, the bid price can rise. It's essentially the buyer's offer during negotiations, usually lower than what sellers are asking. The ask price is the lowest price a seller is willing to accept. It represents supply in the market. Sellers often set higher prices hoping to maximize profit. Trading happens when buyers agree to meet the ask price, completing a transaction between both sides. Spread is the difference between the bid and ask price. It may seem small, but traders pay attention to it because it affects trading costs. A smaller spread usually means a more active market, while a larger spread can indicate lower liquidity or fewer participants. Volume shows how many shares are traded within a certain period. High volume usually means strong interest in the stock, while low volume suggests less activity. Traders use volume to confirm trends, as significant price movements with high volume are often considered more reliable signals. A dividend is a portion of company profits distributed to shareholders. It's like receiving a reward just for owning shares without doing any extra work. Some companies regularly pay dividends, providing investors with passive income while also benefiting from potential price appreciation. A portfolio is the collection of all investments a person owns. It may include stocks, bonds, crypto, or other assets. A well-balanced portfolio helps manage risk. Instead of depending on one investment, diversification ensures that poor performance in one area doesn't ruin everything. Diversification means spreading investments across different assets to reduce risk. Instead of putting all money into one stock, investors choose multiple sectors or assets. This strategy helps balance losses and gains, making overall performance more stable even if some investments don't perform well. EPS shows how much profit a company earns per share. It helps investors understand profitability. Higher EPS usually indicates strong performance. It's like dividing total earnings among shares to see how much each share contributes to the company's success. The PE ratio compares a stock's price with its earnings. It helps determine whether a stock is expensive or cheap. A high PE may indicate growth expectations, while a low PE may suggest undervaluation. Investors use it to compare companies and evaluate investment opportunities. Fundamental analysis involves studying a company's financial health, including revenue, profit, debt, and growth potential. Investors use it to decide if a stock is worth buying. It focuses on real business performance rather than short-term price movements or market speculation. Technical analysis uses charts, patterns, and historical price data to predict future movements. Traders look at trends, support, and resistance levels. It's based on the idea that price patterns repeat over time, helping traders make decisions based on market behavior rather than company fundamentals. A stop loss is an automatic order that sells a stock when it reaches a certain price. It helps limit losses and protect investments. Investors set stop loss levels to avoid emotional decisions and ensure they don't lose too much money during sudden market declines. Liquidity refers to how easily an asset can be bought or sold without affecting its price. Highly liquid assets can be traded quickly. Low liquidity means fewer buyers and sellers, making it harder to complete transactions without changing the price significantly. An ETF is a bundle of assets traded like a stock. It allows investors to own multiple companies in one investment. ETFs provide diversification, lower risk, and convenience. They are popular among beginners who want exposure to a broad market without selecting individual stocks. An index measures the performance of a group of stocks. It represents the overall market or a segment of it. For example, the S&P 500 tracks major companies in the United States, helping investors understand market trends and economic health. ROI measures the profit or loss from an investment compared to the original cost. It is expressed as a percentage. Positive ROI means profit, while negative ROI means loss. Investors use ROI to evaluate how effective their investments have been over time. Short selling involves borrowing and selling a stock, then buying it back at a lower price. Investors profit if the price falls. It's a risky strategy because losses can be unlimited if the price rises instead of falling, making it suitable for experienced traders. A long position means buying a stock with the expectation that its price will increase. Investors hold the asset and wait for appreciation. It is the most common strategy, focusing on growth over time rather than short-term market fluctuations. Cryptocurrency is digital money secured by cryptography and powered by blockchain technology. Unlike traditional currency, it is decentralized and not controlled by banks. Coins like Bitcoin allow peer-to-peer transactions globally, making payments faster, borderless, and dependent on network trust. Blockchain is a distributed digital ledger that records transactions across multiple computers. Each block contains data linked to the previous one, making it secure and tamper-resistant. It ensures transparency because everyone can verify transactions, but no single entity can easily alter them. A crypto wallet stores your digital assets securely. It allows users to send, receive, and manage cryptocurrencies. Wallets can be software-based or hardware devices. They don't actually hold coins, but store keys that give access to assets stored on the blockchain. A private key is a secret code that gives access to your cryptocurrency. It acts like a password and must be kept safe. If lost, access to funds is permanently gone. Sharing it is dangerous because anyone with it can control your assets. A crypto exchange is a platform where users buy, sell, and trade cryptocurrencies. For example, Binance allows users to exchange digital assets easily. Exchanges provide price charts, trading tools, and liquidity for users worldwide to participate in crypto markets. A trading pair shows the relationship between two cryptocurrencies being traded, such as BTC/USDT. It indicates how much of one asset is needed to buy another. Traders use pairs to exchange currencies and track relative value between different assets. Altcoins are cryptocurrencies other than Bitcoin. They include thousands of projects with different purposes, technologies, and use cases. Some aim to improve speed, security, or scalability, while others experiment with new ideas in decentralized finance and digital ecosystems. Stablecoins are cryptocurrencies designed to maintain a stable value, usually linked to fiat currencies like the US dollar. HODL means holding cryptocurrency long-term despite market ups and downs. It originated from a misspelled word but became a popular mindset. Investors HODL when they believe in future growth, ignoring short-term volatility and resisting the urge to panic sell during downturns. Staking involves locking cryptocurrencies to support network operations and earn rewards. It is similar to earning interest in a bank. Users contribute to blockchain security and receive incentives, making it a passive income strategy for crypto holders willing to lock their assets. Yield farming is the process of earning rewards by lending or providing liquidity in decentralized finance platforms. Users move assets between platforms to maximize returns. It can offer high profits, but also involves risks due to market volatility and platform reliability. FOMO stands for fear of missing out. It happens when investors rush to buy assets because others are profiting. Emotional decisions often lead to buying at high prices. Later, if prices drop, investors regret acting impulsively instead of making informed decisions. FUD means fear, uncertainty, and doubt. It refers to negative news or rumors that cause panic in the market. Investors may sell assets quickly due to fear, even when the information is exaggerated or false, leading to unnecessary losses. A rug pull is a scam where developers suddenly abandon a project and take investors' money. It usually happens in crypto projects with hype but little transparency. Investors are left with worthless tokens after the creators disappear without warning. DeFi, or decentralized finance, offers financial services without banks. It uses blockchain and smart contracts to enable lending, borrowing, and trading. Users maintain control of their assets, but they must also handle risks themselves without intermediaries or traditional financial institutions. An NFT is a unique digital asset representing ownership of items like art or collectibles. Unlike cryptocurrencies, NFTs are non-fungible, meaning each one is different. Ownership is recorded on blockchain, making digital items verifiable and tradable in online marketplaces. A smart contract is self-executing code on a blockchain that automatically performs actions when conditions are met. It removes the need for intermediaries, ensuring transparency and efficiency. Once deployed, it cannot be easily changed, making agreements secure and reliable. Gas fees are the transaction costs required to process operations on a blockchain. They compensate network validators for their work. Fees vary depending on network demand, and during high activity, they can become expensive, affecting how frequently users make transactions. Fear versus greed. Panic selling is a common reaction among investors. Many people fall into the trap of the buy high, sell low club because emotions heavily influence financial decisions, especially when fear or greed takes over during investing. One day, you'll laugh at this video because you'll finally understand money and realize you weren't bad with money, you were just never taught properly. It's not just about stocks or crypto. Understanding money is the key, regardless of what you invest in. Stocks or crypto doesn't matter. If you don't understand money, money won't understand you. Education and proper understanding are more powerful than any market tip or trend and make the real difference in personal finance. If you find the video interesting and knowledgeable, don't forget to subscribe Money Decoded for amazing finance-related content.